This is the Financial Thought Exchange podcast, where you get to learn from the leading thinkers in finance. I'm your host, Lotta Moberg, and my guest today is Rob Arnott. He is the partner and chair of the board of Research Affiliates, which he founded in 2002. This is a research-intensive asset management firm. Now, Rob is also co-portfolio manager of multiple funds at PIMCO. He is a prolific contributor to the community of financial research, so we appreciate that a lot. So we appreciate having you here. He's very good at challenging the conventional wisdom, and he's also a pioneer of fundamental indexing, which we will definitely get into today. He is here as the author of a new CFA Institute Research Foundation piece called The Active Side of Indexing, written together with Lillian Wu. And we definitely encourage you to check that out after you heard this conversation. So welcome, Rob.
Wonderful to be here. Thanks.
We'll be talking about indices here, something that a lot of people just take for granted, that is this passive part of the market, and that's all you need to know, right? So we'll allow people to understand that there's a little bit more to know than that, right? So maybe we just start by thinking about this kind of conundrum of, we think of indices as a measure of the market and a natural mechanism also for investing. Now, you bring up those kind of features of it or roles of indices. How do we think of them together and how that sometimes actually becomes contradictory?
Let's start out with the basic issue that these are seen as passive portfolios. They're seen as passive indexes that will match the market. Now, the market, under capital asset pricing model, the market portfolio involves everything that's investable, including arguably human capital. So the spider, the S&P, is actually a shockingly small subset of the global investable portfolio. And so it's important to recognize that indexes capture a part of what we can invest in. It's also really important to recognize that they are not entirely passive. If you have an index, 500 companies, 1,000 companies, whatever, and 95% of the portfolio doesn't change in a given year. It goes up and down with the whims of the market. It doesn't care if companies are thriving or falling apart. It doesn't care if the market itself is soaring or crashing. The 5% that's active is extremely active. The 5% that's active is adding stocks that have crossed into the large cap threshold, where it newly crossing into that threshold, which typically means that these are stocks trading at a lofty valuation multiple after a surge of tremendous momentum. These replace companies that have fallen off that list, often after a long period of disappointment, often at a deep discount to market multiples. So you're systematically buying high and selling low. The oddities involved in the turnover of index funds have not been studied much. So I think this paper is the first deep dive into the nature of index fund trading that looks at it from a whole host of dimensions. If I may, I'll offer a fun little thought experiment. Suppose I came to you and said, I've developed a new strategy. It's awesome. It will attract tens of trillions of dollars, and it will become the go-to portfolio for all investors. Here's what I do. I watch every stock on the market, and if it soars past a certain threshold of market value, I buy it. And the market's, usually it's at a premium multiple, but that's okay because the market's telling us that these stocks are headed places. They're going to achieve great things. Some of them do. They go on to be the next NVIDIA. Others don't. They falter, they fall below that threshold, and we sell them. Those are flip-flops, but they're harmless because it's a small turnover, so it's a small part of the portfolio. What do you think? Most people would listen to that sales pitch and say, you've got to be kidding me. Why would I invest in that? That's an index fund. So if the trading of an index fund is peculiar, then the question we examine is, how peculiar is it? How much does it hurt you, if anything? And what are the alternatives? Are there better ways to do a market tracking portfolio?
We want to get into that, but just to clarify a couple of things you said. That you mentioned on the one hand that the problem is they're selling after prices have gone up, and then you mentioned the flip-flopping. What is the big problem here? Is the problem more about the selling high and buying low, or is it the fact that you end up incurring trading costs by buying, selling things that go in and out of index?
The buying high and selling low is a root cause of the performance drag that's inherent in the trading style of an index. I'm hoping the index community carefully reads this paper, because there are ways, multiple ways, that they can improve what they're doing and deliver a better product. And I hope they're committed to doing that. I think it'd be wonderful fun to watch the industry embrace some of these ideas and alter their products in ways that can deliver more value to the end customer. But flip-flops are kind of interesting. Suppose you have a stock that gets past that threshold, is added to the index, and it doesn't live up to those lofty expectations. Like I said in my illustrative case study, some of them do go on to achieve great things, but some don't. The ones that don't fall because they don't command a premium multiple anymore, fall because their growth turns out to be disappointing, and so maybe the business even shrinks. But the average stock that's added to an index is added at about twice the market multiple. The average stock that's dropped is dropped at about half the market multiple. Every stock that's dropped was once added. So every stock that's dropped is ultimately a flip-flop. The flip-flops I worry about are the ones that happen within, let's say, 10 years. And a lot of them happen within 5 years. So if you have a flip-flop, it was added on a surge of momentum after it rose to inflated, but perhaps justified valuation multiples. You're buying high, but it's maybe worth it, and is dropped after it's fallen to a discounted multiple. In the paper, we quantify this. The average addition to the S&P 500 or the Russell 1000, we use those two as illustrative examples, and I'm not picking on them. They're great index companies, and they've got tremendously important product. But the average stock that's added to the Russell or the S&P will have risen by an average of about 70% relative to the market, 70% excess return in the year prior to being added. Now, you didn't catch that because you added it after the run-up. If it's a flip-flop, on average, it underperforms by 7,000 basis points in the span of time that it's in the index. And so if you're up 70 and down 70, do the math. You're not back where you started, you're down by half. It's ugly. So if you look at the flip-flops, not only did you not catch the up 70, you did catch the down 70, meaning you lost 2/3 of your wealth that was tied up in that stock. Fortunately, your wealth wasn't just tied up in that stock. That's only one stock out of many. But that stock underperformed and lost you 2/3 of what you had invested in it. That's the problem with flip-flops. There's a second kind of flip-flop, and that's a stock that's deleted because it's cratered and it's cheap, and then it comes back into the index sometime later. Might be a year, might be 5 years. Sometime later, it comes back into the index because it regained its footing and is now seen as a worthy candidate for inclusion. Those have the opposite characteristic. On average, they underperform by 3,000 basis points in the year before they're dropped and outperform by 180 percentage points. That's, for those of you who think in basis points, that's 18,000 basis points of outperformance between being dropped and being added back in. The deletion flip-flops are less common, but they happen. And if you're missing out on 180 percentage point outperformance, that means you missed out on a tripling of wealth that you could have had. So you lose 2/3 with an addition flip-flop, you miss out on 2/3 with a deletion flip-flop. It's a 3-to-1 damage every time. Now, anything you do with an index that involves constructing any kind of index, including RAFI, the fundamental index, you're going to have additions and deletions, and the additions may well be companies that have been growing, The deletions may well be companies that have been shrinking. That's certainly the case with fundamental index. But the question is is the turnover high enough to worry about? And B, is the performance damage 3-1? It tends not to be unless you're using price as part of the decision process. By price, I mean market cap.
Now, when you, a lot of people will question what you're saying by saying this, that you're picking the ugliest sheep here in the herd. And when I invest in something that has gone up in price, often there's a momentum effect. So it's actually a good thing to invest in something that is going up in price. You see some examples of some really, really big companies, right? Like Nvidia is great
Absolutely.
to have your position
Yep.
in Amazon.
Nvidia was added at a much lower price than it is now. So yeah, you definitely have winners among the additions. The thing about additions and deletions is you're going to have them. If you make the decision based on price, you're going to be adding because they've soared. You're going to be dropping because they've tumbled. Now, we wrote a paper back in 2017 called "Can Momentum Investing Be Saved?" It got not a whole lot of attention, but I think it was an interesting paper. The title was obviously provocative because everybody thinks momentum works. But the simple fact is, Jagadish and Titman's standard momentum, published in 1993, where you're looking at trailing 1-year return excluding the latest month. That standard momentum, in a FAMA French context where you're choosing the 30% winners and versus 30% biggest losers, in that context, what you find is that standard momentum as a strategy has not worked since 99. That's a quarter century. What I mean is that the long portfolio, which is adjusted and reconstituted every single month, has underperformed the short portfolio over the last 27 years. That's a long time to wait. Now, of course, individual years, some years it wins, some years it loses. It's just net, it's underperformed. And so the narrative that momentum is a winner is true in some contexts, but not in others. Now, lots of people will say, well, we don't use standard momentum. That's old school. All right. How's your momentum worked since you introduced your variant of momentum? The answer is going to be mixed. The other nuance that we pointed out in that particular paper, and again, it's called "Can Momentum Investing Be Saved?" is that the payoff for momentum has a very short half-life. It rolls over fast over the course of 3 to 6 months. So even when momentum's working, it helps you for 3 to 6 months. Then it rolls over, and here's the shocker. It gives the alpha entirely back before 2 years is out. So if you use momentum to choose what stocks to buy, and then you hang on to them, you lose money. If you use momentum to time your entry and exit points, you have a good chance of making money. In other words, if you like a stock because it's cheap and you use momentum to decide when to get in, don't buy it when it's cheap and in free fall. Buy it when it's cheap and has shown that it's regaining its footing. Then momentum can be helpful and can be additive to your returns. But momentum on a standalone basis is way overrated. It is not a powerful tool, and it's a horrible tool for stock selection.
And you mentioned, by the way, a couple of measures to take to ratify this in solutions. And it sounds like you're saying that buying when it enters the index is not a good idea. But actually, when a company exits index, that actually tends to be a sign that they are in more fundamental decline. And therefore, it seemed to be a good idea to sell them when they exit, but not a good idea to buy them when they enter. So how do we think about those different things?
It's a little more nuanced than that. When a stock is added, if you had the prescience to know a year ahead of time that it was going to be added, you could have a 7,000 basis point excess return. But of course, the 7,000 basis points is a big part of the reason it's being added. So that prescience isn't likely to help you unless you can see the future. Once it's added, on average, it has kind of neutral performance. What often happens is a company soars, it's added because it soared, and then one of two things happens. Either the fundamentals catch up to the price, the market was right, the company was going to have wonderful growth, or the market then realizes that, oh, the growth we expected isn't coming through, it's not going to happen, that's a flip-flop. You have some companies where the fundamentals not only catch up to the price movement, but exceed it. Think NVIDIA. Its growth for years and years exceeded all expectations. Well, that's wonderful. And those are the index additions that win, that add value. But the average index addition doesn't help you. It provides market returns. The average deletion, here's where it gets kind of tricky. The average deletion is at deeply discounted prices. People are expecting awful things. The bad news is usually there, but it's already in the price. So in fact, what we find is that going back over the last 30 years, if a stock is dropped, on average, it outperforms the market by 25% in the 5 years after it's been dumped. Now that pattern has disappeared over the last 3 or 4 years. It's too short a span to write it off. And it's a span uniquely attached to soaring Magnificent Seven stocks and a growth-dominated bull market. So I'd be hesitant to dismiss the notion of buying the deletions because may well be just a temporary phenomenon. But in point of fact, over the last 30 years, buying the deletions was worth 500 basis points per annum for the next 5 years. And even over the last 5 years, it's been kind of neutral. So didn't hurt you over the last 5 years and would have helped over the last 30. So it's not quite, as you're saying, that the deletions are in trouble. They may be in trouble, most of them, as a business, but they might not be in trouble as a stock because the market's already discounting a lot of bad news. And all they have to do is have reality be a little less bleak than expectations, and they can do awfully nicely.
Right. It's the comparison with the fundamentals. Because as you mentioned, I mean, the price earnings, other price sales ratio, the fundamental kind of ratios that we might look at, they will be looking way more attractive, like value weighted for these companies to get deleted, right? And we shouldn't be too surprised to see that. And it doesn't mean that
That's
it's
exactly
quite
right.
reflective of the opportunity, that it's not like half the P ratio means that should get twice the return or anything like that necessarily.
No. Mean reversion is a really powerful force at work in the capital markets. It shows up in valuation multiples, it shows up in earnings, it shows up in profit margins. But I like to describe it as unreliably reliable. It works eventually, but it may require a lot of patience.
So you mentioned a little bit about the technicalities that I want to get into. Again, indices, you kind of think that they just kind of happen. It's like magic, and one day we wake up, it's a new price, and it comes in there. But it's actually very interesting. Your paper, you go through how it actually changed over the years, and it was in
Mhm.
1989 there was a really important change there. So
Yes.
they actually extended. They did the opposite of what I would thought, because there is an announcement and then the actually inclusion, and that time period was extended back in 1989. And from your perspective, making it more efficient or better in some way, you can qualify that. Maybe you can tell us a little bit about that, and
Sure.
why that actually was an improvement.
Improvement from the perspective of the index fund manager. It doesn't
Mm,
make a difference for the investor, and it doesn't make a difference for the markets. Pre-announcing was introduced in October of 1989. Before that, typically S&P would announce a change, and Russell did its own thing. So I'll just describe the S&P mechanism first. S&P would decide to make a change in the index on a Wednesday, or would announce it on a Wednesday. They'd announce it after the close, let's say at 4:30 p.m., and they would say this change is effective as of 30 minutes ago, as of today's close. Now, if you're running an index fund, let's say Tesla is added, and it's added at today's close, and it's already closed. Now you're an index fund, and you have to collectively, the S&P owns about 1/4 of every stock that's in the S&P. S&P indexers are now a fourth, not a fourth of the stock market, a fourth of the
mm,
stocks that are in the index. So that's a big deal. Now,
mm.
what that means is that if that rule were applied today, Tesla was announced on November 16 to be included on December 21. So people were given 4.5 weeks. Cool. But on the day that the announcement happened, the index funds would have to come in the next day and say, we want to buy 25% of the total shares outstanding of Tesla. No, we don't want to buy. We have to buy. Not only that, we have to buy no matter what price it is. Oh my goodness. So set whatever price it is, and we have to buy. So between adding it on December 21 really meant at the opening on the 21st, meaning the close on the 18th. So between the announcement, the pre-announcement close on November 16 and the close on the effective date on the 18th, the stock was up 70%. That's an enormous trading cost. I describe it as a trading cost. Indexers will often compare the price of implementation with the day's close. Well, gosh, what a surprise. It matches. Or against the previous day's close and say, see, we didn't move the price much. No, hedge funds were able to come in after the announcement and say, okay, index funds have to buy 25% of this company. Let's buy it now and flip it to them. That's what drove the price up to 70%. So the index addition was the actual reason for having the price move. And because that was the reason for the price move, it's a trading cost. Most of the time, the trading costs aren't that large. Additions on average come in at 6 or 8% above the announcement price. Deletions 6 or 8% below the announcement price. Okay, but it's still a legitimate trading cost. Multiply an average of a 12% or 14% spread between the additions and deletions times 5% turnover, and you've got to call it a 60 basis point drag on returns. Nobody notices the trading costs. Nobody notices the drag on returns because the index is its own benchmark. And if you are running an index fund and you know that Tesla's coming in and you know that you have to buy 25% of the stock, you're going to put in an order to buy it. It's called a market on close order, to buy it market on close on December 18 so that you exactly match the price at which it comes into the index. Well, that day, I don't remember the exact numbers, but it rose about 5% that day. So you could have bought it at the start of the day for 5% less. You didn't want to do that because you want zero tracking error. We've trained the world to think that tracking error means you're being sloppy. It doesn't mean you're being smart. It means you're being careless and stupid. And so we've trained a generation of index fund buyers to understand that exact index tracking is a sign of profound competence, when in fact it could be a sign that you're just being chicken about trying to do better for your clients.
Is there any regulation, to your knowledge, kind of binding them to have to kind of act that herd-like?
I'm 99.9% sure that there's no such thing. Now,
Yeah.
ETFs, index ETFs have a requirement to be 95% match with the target index. So when Tesla came in, I think it was 1.7%. They could have bought the whole thing on the day of the announcement. They could have speculated a year ahead of time and said, you know, this company's getting big. It's got to come into the index as soon as it shows any signs of profit. The shocking fact is that people were starting to talk about that in March of 2020. People were starting to say, S&P has a rule. Stocks get added after 4 consecutive quarterly profits, and it's deferred if they don't have that. Now, with S&P, the rules are more guidelines than rules. They have the right to waive them. It is an index committee decision, but they try to follow their rules pretty reliably, and that's one that they haven't thrown out. In fact, they're not throwing it out for SpaceX, for instance. They came out with an announcement that they're not changing their rules to allow these huge AI IPOs to come in early. But Tesla had its 3rd consecutive profitable quarter in the first quarter of 2020. So people were starting to say, okay, one more quarter, and it's coming into the index. From the March lows in 2020 to the date of addition, the stock rose almost tenfold.
For posterity, people will not remember this. Something happened in March 2020. What was that?
Well, there was COVID. COVID whacked
Yes.
everything down.
World shutdown from pandemic. Yes.
It did have a pricing impact, but relative to the market, it was still a six-fold increase.
So this gets you did mention this in terms of, well, people start acting in advance. So just to nail this so that it's very clear, it might seem right like if you're going to start now announcing it way earlier, there's more opportunity for kind of front running, and it's which sounds like it's a bad thing. It decreases efficiency, but that's actually not. The more the liquidity part is way more powerful.
I think the market has become way more liquid during the course of my career. Bid-ask spreads have tightened. People think of high-frequency traders as wicked capitalists exploiting the little guy. No, they win by there's a bid-ask spread, and they say, our high-frequency trading model says the next price is going to be an uptick, and therefore I'm willing to go above the current bid. I'm going to come in at quarter cent higher. And then they flip it a little later at that higher price that they anticipated. Well, that's great because you didn't have to sell down here, you could sell here. You didn't have to buy up here, you could buy here. And so bid-ask spreads are way, way tighter than they were earlier in my career. It's been wonderful to see. The market liquidity is terrific, which isn't to say that it can't make big moves fast when there's news or when there's an abrupt evaporation of interest in owning stocks. The flash crash a few years back being a vivid example. Market dropped, I think, 6% in the space of 10 minutes. Okay, well, that market tumult has been with us since the dawn of markets. But what's cool is that 99% of the time you can trade shockingly cheap.
Another thing that you mentioned here that I want to clarify is you mentioned that when you had the short window, that it's not perfectly corrected here with the longer window, but still it's bad for the fund, but it's good, but it's not bad for the investor. So what's the difference? Because we think of investors as they are the ones investing in the funds, right? So what's the distinction
if you had a fund that was happy to trade on the announcement date, it would have done, we measured this. I think the number was 12 basis points. It would have done 12 basis points better than the index. If the purchases for Tesla had been the morning of the 17th of November instead of close of trading on the 18th of December, you would have wound up buying at a far lower price. On average, across hundreds of additions and deletions, the return is improved by, I think the number was 12 basis points per annum for 30 years. You wind up 4 or 5% richer after 30 odd years, which isn't huge, but it's 4 or 5% richer. That's nice, just by trading immediately after the announcement. So yeah, it does hurt in the investors. It doesn't hurt them by a huge margin, but it does hurt them. And yet we've trained the customers to think that buying at any price other than the price at which the index embraces the new stock is careless and sloppy. It's not. It can be careless and sloppy, or it can be a deliberate attempt to eke out a few additional basis points of return. I have a dear friend who used to be head of indexing at a jumbo indexer. They did this kind of thing. They looked at little niche strategies to do just a little better than the index. And they were routinely adding 5, 10, sometimes 15 basis points. And their marketing team finally came to them and said, stop it. We're losing a ton of business because we're being accused of being sloppy.
Sloppy? What?
Because they had tracking error. It was positive tracking error, but it was tracking error. If you can add 15 basis points next year, you're going to lose 15. No, we won't. Oh, you might. I don't want to work with you.
Just call it like a smart beta strategy or something like that, and I'll perform a little bit.
Well,
I think that, but I'm not going to
now,
question
smart
them,
beta is a way overused term. I've been called the godfather of smart beta because fundamental index was the inspiration for Towers Watson to coin the expression smart beta, but it's now attached to everything under the sun, including some ideas that are smart and some ideas that are profoundly stupid. But an index strategy that tries to handle the additions and deletions a little bit more carefully is still an index fund.
Yeah.
The
And-
correlation,
yeah.
we have our own cap-weighted index, which we'll talk about in the next segment, which simply dispenses with choosing stocks based on their market value and chooses them based on the size of the business. That adds, going back over the last 35 years, it adds about 70 basis points per annum. Well, that's pretty cool. And that means that 70 basis points per annum was left on the table by choosing to add or drop stocks based on market value. It's a huge difference, but we'll get into that in the next segment.
We sure will. And I should clarify also whether you're talking about the fundamental index and the example that you gave, just not buy when it's included, but prior to that, get an extra 12 basis points annually. It doesn't assume that it's not insider knowledge that I know it was going to be added. You assume that you wait a full day after everybody knows. So presumably the price goes up a lot that day. It's just that it keeps going up until inclusion.
That's exactly right. If you could trade at the price it was added, you would add 20 basis points. If they called you up, you and you alone, they called you up and said, at 4:30, we're going to announce that we're adding XYZ and dropping ABC. Then you trade at the close, the announcement date. You have that inside information. You have an index that wins almost every year by an average of 20 basis points. If you trade the next day, you add about half that. But you're still adding value, which is cool. You can even wait until a day or two after the official date, because the official date pushes the price up and there's usually a retreat the next 2 days. So you could even add an average of 3 or 4 basis points by trading 2 days late. That's kind of cool.
Okay. And we should mention too, because I can get this mixed up. Maybe it's not obvious that you're talking about the aggregate strategy, whether we're talking about the 12 base one. It's not on that specific stock until it gets included. It's
on the
if I just persistently do this, then any time,
It's on the total
average.
portfolio. And
Right.
in a business where people squabble over a basis point of fees, this one charges you 0, this one charges you 3 basis points, this one charges you 5. People are squabbling over single basis points, and here's a chance to add 10, 20, 40 or 50 and still have an index fund. Wow, that's a lot to leave on the table over an argument that if you're not tracking exactly, you're doing something wrong.
Yeah. So just to end on a more philosophical note here, we do have Sharpe's dictum that says there is a universe out there, and that kind of assumed to be fixed, and therefore you can derive certain things from that. For example, that he says that there kind of makes no sense to be active because on average we're all going to perform the average of the index. So most active, like half of the active managers, will perform in line with just being passive. How should people think differently about that in the real world, knowing what we know about indices?
There's something called Goodhart's law, which says if you create something that's a measure, S&P 500 as a measure for how the market's performing, and you go from using it as a measure to using it as a tool, it ceases to work as well as a measure as it used to. And that can apply in the sciences. It can also apply in the index world. There's an exhibit in the paper that looks at the top 500. Firstly, S&P 500 is thought of as the 500 largest market value companies in the United States. It's not. It's 500 companies selected by their index committee. There's big overlap. About 380 of the stocks, about 90% of the weight in the portfolio, overlaps with the 500 largest market cap. So for our research, we construct a true cap 500. Basically, once a year, you take the 500 largest market cap, bingo, that's your index. It has a 99.9% correlation with the S&P 500. Cool. All right. So it's highly correlated. But on average, there's 120 stocks in the S&P that don't make the cut as not being, they're not one of the 500 largest market cap companies, which reciprocally means that there's 120 stocks in the S&P that are now small cap or small to mid cap. And that's fine. They do this in part to tamp down the turnover. And so it's on a sensible basis. But circling back to Sharpe's dictum, Sharpe wrote a paper in the early 90s entitled The Arithmetic of Active Management. And in that paper, he pointed out that index funds' role is to own the market. If you divide the world into index funds and active managers, these own the market. Take them out of the picture, what you're left with is the market. Identically the same portfolio. This is what the active managers hold. The portfolios are the same. My goodness, the returns have to be the same, except the active managers have higher fees and higher trading costs, so they cannot win. The logic is impeccable. The gap between that logic, George Bach's famous dictum was, all models are wrong, some models are useful. The model that active managers must own the market because the index funds own the market and take them out is still looking at the market isn't true. S&P 500 owns 500 stocks. There's something like 3,800 stocks in the US, so that means 3,300 that they don't own, not to mention all other assets in the world. So the question we explore, there's an exhibit in our paper for those who want to do a deeper dive. It's Exhibit 5 that looks at the True Cap 500 and the S&P, 99.9% correlation, so they track almost identically. But top 500 versus the next 500, the stocks that are ranked 501 to 1,000 in the US stock market, reconstituted once a year. What we found was that in the 1990s, on average, these were priced about the same, priced at the same valuation multiples. They also had growth in profits, cash flow specifically, growth in profits that was nearly identical. As index funds became more popular, Goodhart's law kicked in, and the two portfolios started to behave very differently. What happened first was the aftermath of the dot-com bubble. The top 500 crashed relative to the next 500. Well-known bit of history. For the next 7 years, give or take, growth and large cap underperformed small cap in value. Now, a big chunk of that was falling valuation multiples for top 500 versus next 500. A big chunk of it also was that the top 500 had slower growth. So the fundamentals were eroding, the valuation multiples were eroding. Bingo, you underperform ferociously, losing over half your value relative to the next 500. That flipped in about 2014, 2012 to 2014. And what we saw was that the performance of the top 500 versus the next 500 started to improve drastically. And this is what we've seen for the last dozen years. Large cap has beat mid cap and small cap by a wide margin for over a decade. Wow. The narrative is these top companies are great companies. They're doing great things. They're destined for greatness. And the ones that don't make the cut, they're also RANs. They're destined to, some of them will do great things, but most of them won't. So why bother? And the simple, shocking reality is that the top 500 have had slower growth in profits, slower growth in cash flow by about 3% per annum relative to the next 500. So the next 500 have had profit growth 3% per annum better than the top 500. And the top 500 has outperformed by over 3% per annum, somewhere in the 4 or 5% range, meaning that the valuation multiples have been exploding upward by about 7 or 8% per annum relative to the next 500. And the result is that at the top of the dot-com bubble, the top 500 were priced at about a 45 to 50% premium valuation multiple relative to the next 500. At the end of last year, it reached 80% premium. You're paying 80% more per dollar of cash flow than you are for the next 500, even though that next 500 has faster profit growth by 3% per annum, going back a quarter century. Fascinating. People don't notice these inefficiencies because they obsess with the notion that the index is the market. The thing that Bill Sharp missed in the arithmetic of active management was that the use of index funds might cause the valuation spread between index fund members and non-members to widen relentlessly due just to the flow of money into index funds. And so Goodhart's law takes something that was intended as a measure and find an application for it, and its use as a measure is compromised. Just fascinating stuff.
And I feel like where you're getting to as well is that prior to Goodhart's law kicking in here, it was all the supply effect, and that's why they could look similar. But now we have this huge demand effect, and you change the demand, voila, you get prices increasing.
So in 2000, 10% of all mutual fund and ETF assets were in index funds, up from about 3% in 1990. So it tripled from 3 to 10% in a single decade. Wow, that's tremendous. Except it went from 10% to 50% by 2024. So 50% of all mutual fund and ETF assets are now index funds. That's, I think the technical term is ginormous. Now that doesn't count money, investment capital that's not in index funds, but a lot of that is big pensions, and a lot of big pensions have, the big institutional investors have large amounts of money in index funds. So it's probably not dissimilar for the market as a whole. If half of the money is indexed, and if those indexes, S&P owns about 80%, the S&P index spans about 80% of US stock market capitalization. If half of the market is index funds, and hypothetically, obviously I'm oversimplifying, I'm ignoring the broad indexes and the Russell 1000, but if the index funds collectively span 80% of the market, then that must mean that they own about 0 of the stocks that aren't in the index, and about 60% of the stocks that are in the index, not 50, not half. And the active community, they own 100% of the stocks that aren't in the index, and about 40% of the stocks that are. So the active community no longer owns the market portfolio. The overlap between the two portfolios is probably only about 60 or 70%. It's not 100, as would be postulated in the active share of associated with indexes versus active.
So saying that S&P is the market is quite misleading.
Yeah, it's not the market. It's a terrific index, and they've done a terrific job. Very minor factoid. If you look at the top 500 constructed mechanistically, what you find is that the performance is just a touch better than the S&P. Did they leave money on the table? Not really, because it's more than a touch higher risk. The risk-adjusted return for the S&P is higher, and the underlying cash flow gains of the S&P are 5 to 10 basis points a year better than for a mechanistic top 500. So I'd say the committee has done a nice job of filtering out some speculative companies, some of which come and go, and some of which turn out to be brilliant companies. But the gap between the two is very, very small. And on a risk-adjusted basis and on an earnings growth basis, it slightly nudges in favor of the S&P Investment Committee having done a nice job.
So everybody's listening now, they're wondering, how am I going to become a better investor knowing all of these facts now and having these new insights? And for that, you have to check out our second conversation where we continue this conversation with Rob Arnott. So I thank all of you for tuning into the Financial Thought Exchange podcast. I've been your host, Lotta Moberg. Our guest is Rob Arnott, partner and chair of the board of research affiliates and author of the Research Foundation Brief, Active Side of Indexing, together with Lilian Wu. Thank you so much, Rob.
Thank you.
And we will see you in the next conversation.
For more information, please visit rpc.cfainstitute.org/research-foundation.